Okay, so central bank, market maker, trader. Now there is a bit of a wall here. Okay, the central bank, while it does supply the money, it doesn't really have much of a day-to-day or trade-by-trade control on how that money gets pushed around. They will influence the money flow by their statements, by their stance on things like interest rates and whatnot, but they don't really muck around with the individual market makers. They leave that up to the free market. Now the trader, on the other hand, they've got zero control. Okay, even the big hedge funds have zero control over where the market goes, and so the control is really focused here and here. But with this wall, we don't necessarily have to be as concerned with the central bank. So let's talk about now the market maker and how the market maker is going to be the key for understanding how we can actually predict some of these reversals far in advance. Okay, so let's go back to supply and demand. And I apologize if the screen looks jumpy. I've actually got some kind of issue with my computer. It's running slow intermittently. Supply and demand. Okay. Supply and demand. Remember we talked about in the introductory comments here about order flow. Okay? Order flow is the key to the marketplace. The reason why retail traders, the reason why you don't hear about this stuff on the message boards, you don't hear about it in most courses, is most people selling this stuff have had little or no professional experience. The professional is concerned about order flow. The market maker is concerned about order flow. And remember, our main concern, in fact, let me put it right here at the top. We are concerned about the market makers. Why are we concerned about the market makers? We're concerned about the market makers because these are the people who are controlling the currency. Remember, the market makers are the ones that have the supply. Since they have the supply, they can control to a certain extent the supply and the demand, which means that if there's a change in supply and demand, these are the guys who are going to really make it happen. So, what happens to influence this order flow, and how does that how is that applied to the Little Dipper and the sneak attack? Well, let's take a look at a few of these areas on the chart. Okay, this area here is a consolidation area. This area here is a consolidation area. These two price ranges form, if you've been watching my videos at all, form what's called a zone of support or resistance, depending on where price is. Now, let's talk about why we can call it support and why we can call it resistance. Now, this isn't some pie-in-the-sky esoteric theory here. This is the reality of how the market makers and the other economists and the bankers and these market participants actually think. Okay, we're getting into the heads of traders. That's the key for you to understand, is we are truly understanding how the market players are going to act, and to a degree how they're forced to react. That's how we can actually get to the point where we can predict some of this stuff. Okay, if price is below a certain area, the reason why we call it resistance is because of the order flow. Remember, order flow is key. Here's why. And listen to me good here. Listen to me close and listen to me good. If a market maker doesn't have an order, they have no financial incentive to move price. Absolutely zero. You're a market maker, whether it's your broker, a big bank, it doesn't matter. They have no incentive to move price because it exposes them to risk. They're called a market maker for a reason.